I'd like to first welcome our new Vice Chairman, Congressman T. Berry, and we've had a Congressman Brady as I either want to say promoted or demoted to Chairman of the Ways and Means Committee. We are very, very happy to have Congressman T. Berry take over as Vice Chair. Welcome. And I also want to welcome our distinguished Chair of the Federal Reserve, Janet Yellen, and thank her for appearing before us this morning. This committee has a long tradition of receiving regular updates from the Chair of the Federal Reserve, and we're pleased to be continuing that tradition today. The U.S. economy has struggled through a long season of tepid growth. It's been 6 years since our last recession technically ended, and over that time, our economy has grown at a historically slow pace, averaging 2.2% per year. Some have suggested that a 2% growth rate is and will be the new normal for the economy. All of us should view these low economic expectations as unacceptable. The Fed certainly has an important role to play in setting monetary policy, and that is where its focus should be. There will no doubt be discussion of Fed policy and interest rates during today's hearing, as accommodative monetary policy by the Fed has been the norm for some time now. However, we should also be mindful that changing interest rates is not a long-term prescription for achieving a more dynamic economy. Unlocking the full potential of our economy will require policy decisions that incentivize the private sector, including better fiscal management of spending by the federal government, as well as pursuing pro-growth policies such as tax reform, a more balanced regulatory environment, and passage of trade agreements and other policy commitments. Our commitment to successfully addressing these other policy issues, and by our, I mean the United States Congress, not the Federal Reserve, will go a long way toward creating certainty and confidence among both businesses and consumers. If we do not succeed in furthering pro-growth policies, we may face an economic future defined by low expectations and diminished standards of living. At the same time, questions arise regarding the impact of weakening economies in Europe, China, and emerging market countries. This morning, the European Central Bank announced that it's expanding its stimulus measures and taking its overnight deposit rates further into negative territory. China devalued its currency in August in response to financial turmoil, and other major international trading partners face significant economic challenges. The actions taken by these countries will have an impact on the value of the dollar and the U.S. economy. We look forward to hearing the Chairman address that issue also. These are some of the major issues we will discuss, and I certainly look forward to hearing Chair Yellen's thoughts on this. There is global uncertainty also. I think that we should add to this equation. Too many mornings we tune into breaking news or pick up the newspaper and find headlines that we don't want to read. That appears to be a spreading cancer not only in the United States but also throughout the world. And so the uncertainty that levels and the impact that it has on economic policies is perhaps another issue that we ought to be discussing. This morning, unfortunately, the House of Representatives it has a series of votes coming up shortly, so there may be some in and out of members having to deal with that as we are trying to wrap up our session. I'm going to try to ask our members, I will ask our members to try to keep their remarks to and questions to 5 minutes. If we need a second round, we will try to accommodate that, and also try to accommodate those that have had to run out for votes and will come back. Chair Yellen, most of us sitting, if not all of us sitting up here today, would love to wake up to headlines in the Wall Street Journal, headlines in the New York Times, pictures on the front page of Financial Times, and I have all these things that highlight you this morning as the person of the day. I don't expect that you have that same enthusiasm for waking up every morning, but we're really pleased to have you here and look forward to your testimony. First, though, I'd like to turn to Congresswoman Maloney, our ranking member, and then ask Mr. Teaberry to take a minute or so just to introduce himself to us as our new Vice Chairman on the House side. Congresswoman Maloney.
Thank you. Thank you so much, Mr. Chairman, and so welcome, Chair Yellen. I am so pleased you're here today for this important and timely discussion. I look forward to your testimony in advance of the Federal Open Market Committee's meeting, at which you will decide whether or not to raise the federal funds rate. I am interested in hearing your perspective on the following issues and others. What current trends do you find most important in helping you assess the short and long-term challenges facing our economy? Secondly, how can the Federal Reserve time future rate increases so we don't jeopardize the current economic recovery or hurt American families? Thirdly, what do you think of the legislation recently passed by the House of Representatives that would compromise the independence of the Federal Reserve? Before I turn to these issues and others, I think it's important to put this hearing in perspective. At the end of the Bush administration, just a little less than 7 years ago, we faced what former Fed Chairman Bernanke called, and I quote, "the worst financial crisis in global history, including the Great Depression," end quote. We have come a long way since economic crisis, and that progress is in no small part due to the bold actions by the nonpartisan, non-political Federal Reserve. In the month when President Bush left office, we lost almost 820,000 private sector jobs. Over the past year, we have gained an average of 226,000 jobs per month. In fact, we've added 13.5 million private sector jobs over a record-breaking 68 consecutive months of growth. I have this chart, and I'd like to put it in the record, which explains and documents this growth. In October 2009, unemployment reached 10%. Since then, it has been cut in half. It now stands at 5%. There were about 7 unemployed workers for every job opening in July of 2009. Now there are 1.4 unemployed workers per job opening, the lowest this ratio has been since early 2001. Real GDP fell 4.2% between the end of 2007 and the second quarter of 2009. But GDP has increased by more than 14% since then. Growth has been positive in 23 of the last 25 quarters. Average home prices dropped 19% between 2007 and 2011, but now they're back up to where they were in 2007. About $17 trillion in wealth evaporated between the summer of 2007 and the beginning of 2009. All of those losses have been recovered, and now total wealth is about $10 trillion, higher than it was at the onset of the financial crisis. The Federal Reserve played an extraordinary role turning around the economy. It quickly acted to lower rates to almost zero and has held them there for about 7 years, which has been a principal factor in our economic recovery. The Fed did this despite the opposition of those who claimed that inflation was on the horizon and who were later proven wrong. Then, having exhausted the conventional tools of monetary policy, the Fed deployed several rounds of quantitative easing aimed at keeping long-term rates low and further stimulating our economy. These efforts helped haul our country out of the depths of the Great Recession. But without the Fed's actions, things would be very different today. A recent study by economists Alan Blinder and Mark Zandi found that efforts by the Federal Reserve and the Obama administration, with support from Democrats in Congress, dramatically reduced the severity and length of the Great Recession. Specifically, the report found that without their joint efforts, the recession would have lasted twice as long. The unemployment rate would have reached nearly 16%, and we would have lost twice as many jobs, more than 17 million American jobs. I'd like to enter the Blinder-Zandy report into the record. Ironically, Republicans in Congress made recovery more difficult. As former Reserve Chairman Ben Bernanke wrote in his new book, which I recommend, and I quote, "The economy needed help from Congress, if not from additional spending on roads and bridges, for example, then at least in areas such as retraining unemployed workers," end quote. But the Republican-led Congress demanded deep spending cuts at a time when we needed aggressive fiscal policy to boost the economy. They ended up doing more to hurt than to help. And now Republicans complain that the economic recovery has been too slow. Now they have gone to one step further. 2 weeks ago, Republicans in the House of Representatives passed, in my opinion, damaging legislation, the FORM Act, that would fundamentally hamper the Fed's ability to conduct monetary policy. It would hurt the Fed's independence, for example, by forcing it to determine target interest rates using a mathematical formula, while ignoring a broad range of important economic indicators. Chair Yellen, as you have noted before, if the Fed had been forced to follow such a rule in recent years, and I quote from you, millions of Americans would have suffered unnecessary spells of joblessness over that period, end quote. If the FORM Act had been a law during the time of the recession, the Federal Reserve would not have been able to take the aggressive steps needed to help pull our nation out of the greatest economic crisis since the Great Depression. I hope today that we can focus on the critical issues before us, how the Federal Reserve should act to strengthen our economic recovery. But if necessary, we must clearly show that efforts to hamstring the Federal Reserve are misguided and dangerous. Chair Yellen, thank you for appearing before the Joint Economic Committee today, and I look very much forward, as always, to your testimony.
Thank you, Congressman T.
Thank you for your courtesy, Chairman. I want to thank Chairman Ryan for giving me this opportunity, and I want to thank you for your Indiana Hoosier niceness in this process. You've been, you and your staff have been great in welcoming me. I look forward to working with my colleagues from the Senate as well as the House. I know we have, in Ohio at least, still many challenges. A lot of moms and dads are underemployed. Yes, the unemployment rate has gone down, but there's a tremendous amount of anxiety, I know, in our state about the future of the economy, and this is so important. Chair Yellen, thank you for your time today. I look forward to hearing from you.
Thank you. I'd like to now introduce our witness. Janet L. Yellen took office as chair of the Board of Governors of the Federal Reserve System on February 3, 2014, for a 4-year term ending February 3, 2018. Dr. Yellen also serves as chairman of the Federal Open Market Committee, the system's principal monetary policy-making body. Prior to her appointment as chair, Dr. Yellen served as vice chair of the Board of Governors, taking office in 2010, when she simultaneously began a 14-year term as a member of the board that will expire not until 2024. Dr. Yellen is professor emeritus at the University of California at Berkeley, where she was the Eugene E. and Catherine Trefethen Professor of Business and Professor of Economics, and has been a faculty member there since 1980. Dr. Yellen took leave from Berkeley for 5 years starting in August of 1994. She served as member of the Board of Governors of the Federal Reserve System through February of 1997, and then left the Federal Reserve to become chair of the Council of Economic Advisors through August 1999. She also chaired the Economic Policy Committee of the Organization for Economic Cooperation and Development. She has served as President and Chief Executive Officer of the Federal Reserve Bank of San Francisco and has a distinguished academic background. Dr. Yellen, we are pleased to have you here this morning. Thank you very much for coming. This is an important time. You've had a busy week, and we appreciate you taking the time to share with us your thoughts on where we are and where we're going with this economy and the role of the Federal Reserve.
Thank you very much. Chairman Coates, Ranking Member Maloney, and members of the committee, I appreciate the opportunity to testify before you today. In my remarks, I will discuss the current economic outlook before turning to monetary policy. The U.S. economy has recovered substantially since the Great Recession. The unemployment rate, which peaked at 10% in October 2009, declined to 5% in October of this year. At that level, the unemployment rate is near the median of Federal Open Market Committee participants' most recent estimates of its longer-run normal level. The economy has created about 13 million jobs since the low point for employment in early 2010, and total non-farm payrolls are now almost 4.5 million higher than just prior to the recession. Most recently, after a couple of months of relatively modest payroll growth, employers added an estimated 271,000 jobs in October. This increase brought the average monthly gain since June to about 195,000, close to the monthly pace of around 210,000 in the first half of the year, and still sufficient to be consistent with continued improvement in the labor market. At the same time that the labor market is improved, U.S. economic output, as measured by inflation-adjusted gross domestic product, or real GDP, has increased at a moderate pace on balance during the expansion. Over the first 3 quarters of this year, real GDP is currently estimated to have advanced at an annual rate of 2.25%, close to its average pace over the previous 5 years. Many economic forecasters expect growth roughly along those same lines in the fourth quarter. Growth this year has been held down by weak net exports, which have subtracted more than 0.5 percentage point on average from the annual rate of real GDP growth over the past 3 quarters. Foreign economic growth has slowed, damping increases in U.S. exports, and the U.S. dollar has appreciated substantially since the middle of last year, making our exports more expensive and imported goods cheaper. By contrast, total real private domestic final purchases, which includes household spending, business fixed investment, and residential investment, currently represents about 85% of aggregate spending. It's increased at an annual rate of 3% this year, significantly faster than real GDP. Household spending growth has been particularly solid in 2015, with purchases of new motor vehicles especially strong. Job growth has bolstered household income, and lower energy prices have left consumers with more to spend on other goods and services. Increases in home values and stock market prices in recent years, along with reductions in debt, have pushed up the net worth of households, which also supports consumer spending. Finally, interest rates for borrowers remain low, due in part to the FOMC's accommodative monetary policy. And these low rates appear to have been especially relevant for consumers considering the purchase of durable goods. Other components of private domestic final purchases, including residential and business investment, have also advanced this year. Indeed, gains in real residential investment spending have been faster so far this year than last year, although the level of new residential construction still remains fairly low. And outside of the drilling and mining sector, where lower oil prices have led to substantial cuts in outlays for new structures, business investment spending has posted moderate gains. Turning to inflation, it continues to run below the FOMC's longer-run objective of 2%. Overall consumer price inflation, as measured by the change in the price index for personal consumption expenditures, was only 0.25% over the 12 months ending in October. However, this number largely reflects the sharp fall in crude oil prices since the summer of 2014. Because food and energy prices are volatile, it's often helpful to look at inflation excluding those two categories, known as core inflation, which is typically a better indicator of future overall inflation than recent readings of headline inflation. But core inflation, which ran at 1.25% over the 12 months ending in October, is also well below our 2% objective, partly reflecting the appreciation of the U.S. dollar, which has pushed down the prices of imported goods, placing temporary downward pressure on inflation. Even after taking account of this effect, however, inflation has been running somewhat below our objective. Let me now turn to where I see the economy is likely headed over the next several years. To summarize, I anticipate continued economic growth at a moderate pace that will be sufficient to generate additional increases in employment and a rise in inflation to our 2% objective. Although the economic outlook, as always, is uncertain, I currently see the risk to the outlook for economic activity and the labor market as very close to balanced. Regarding U.S. inflation, I anticipate that the drag due to the large declines in prices for crude oil and imports over the past year and a half will diminish next year. With less downward pressure on inflation from these factors and some upward pressure from a further tightening in U.S. labor and product markets, I expect inflation to move up to the FOMC's 2% objective over the next few years. Of course, inflation expectations play an important role in the inflation process, and my forecast of a return to our 2% objective over the medium term relies on a judgment that longer-term inflation expectations remain reasonably well anchored. Let me now turn to the implications of the economic outlook for monetary policy. In the policy statement issued after its October meeting, the FOMC reaffirmed its judgment that it would be appropriate to increase the target range for the federal funds rate when we had seen some further improvement in the labor market and were reasonably confident that inflation would move back to the committee's 2% objective over the medium term. That initial rate increase would reflect the committee's judgment based on a range of indicators that the economy would continue to grow at a pace sufficient to generate further labor market improvement and a return of inflation to 2%, even following the reduction in policy accommodation. As I've already noted, I currently judge that U.S. economic growth is likely to be sufficient over the next year or two to result in further improvement in the labor market. Ongoing gains in the labor market, coupled with my judgment that long-term inflationary expectations remain reasonably well anchored, serve to bolster my confidence in a return of inflation to 2% as the disinflationary effects of declines in energy and import prices wane. Committee participants recognize that the future course of the economy is uncertain, and we take account of both the upside and downside risks around our projections when judging the appropriate stance of monetary policy. In particular, recent monetary policy decisions have reflected our recognition that with the federal funds rate near zero, we can respond more readily to upside surprises to inflation, economic growth, and employment than to downside shocks. This asymmetry suggests that it's appropriate to be more cautious in raising our target for the federal funds rate than would be the case if short-term nominal interest rates were appreciably above zero. Reflecting these concerns, we have maintained our current policy stance, even as the labor market has improved appreciably. However, we must also take into account the well-documented lags in the effect of monetary policy. Were the FOMC to delay the start of policy normalization for too long, we would likely end up having to tighten policy relatively abruptly to keep the economy from significantly overshooting both of our goals. Such an abrupt tightening would risk disrupting financial markets and perhaps even inadvertently push the economy into a recession. Moreover, holding the federal funds rate at its current level for too long could also encourage excessive risk-taking and thus undermine financial stability. On balance, economic and financial information received since our October meeting has been consistent with our expectation of continued improvement in the labor market. And as I've noted, continuing improvement in the labor market helps strengthen our confidence that inflation will move back to our 2% objective over the medium term. That said, between today and the next FOMC meeting, we will receive additional data that bear on the economic outlook. These data include a range of indicators regarding the labor market, inflation, and economic activity. When my colleagues and I meet, we will assess all the available data and their implications for the economic outlook in making our policy decision. As you know, there has been considerable focus on the first increase in the federal funds rate after nearly 7 years in which that rate was at its effective lower bound. We have tried to be as clear as possible about the considerations that will affect that decision. Of course, even after the initial increase in the federal funds rate, monetary policy will remain accommodative. And it bears emphasizing that what matters for the economic outlook are expectations concerning the path of the federal funds rate over time. It is those expectations that affect financial conditions and thereby influence spending and investment decisions. In this regard, the committee anticipates that even after employment and inflation are near mandate consistent levels, economic conditions may for some time warrant keeping the target federal funds rate below levels the committee views as normal in the longer run. So in closing, let me say the economy has come a long way toward the FOMC's objectives of maximum employment and price stability. When the committee begins to normalize the stance of policy, doing so will be a testament also to how far our economy has come in recovering from the effects of the financial crisis and the Great Recession. In that sense, it is a day that I expect we are all looking forward to. So thank you. Let me stop there. I would be pleased to take your questions.
Chair Yellen, thank you very much. It is a day we have long waited for, and hopefully your positive remarks today will bear that out and set us on the right trend, a positive trend. As we had discussed earlier in private, I want to raise this in public. While our trends are moving toward positive territory, the EU's trends seem to be moving into negative territory with negative overnight interest and deposit rates. Also, additional thoughts about ways to stimulate their economy. They play a major role in the world economy. We see slowdowns in China. We see problems, significant problems in Brazil and throughout many emerging markets. My question is, how that clearly is the world, much of the world seems to be on a negative trend. How do you balance those two issues out relative to their impact on each other? And how does the FOMC take that into consideration in terms of their decision making?
Well, thank you for that question. We have seen relatively weak growth in the global economy, with different parts of the global economy faring differently, but relatively weak growth. The U.S. has enjoyed stronger growth in labor market performance. That weak growth shows through to the demand for U.S. exports, and it's one factor that has been depressing U.S. net exports. In addition, that difference in strength between the global economy and the U.S. And reflected also in different expectations about the path of monetary policy. As you noted, the ECB has added stimulus, has taken additional actions today to provide further stimulus, while there's an expectation that the FOMC is coming closer to raising rates. That difference in expectations about monetary policy, reflecting different underlying strength, has led over the last year and a half to a substantial appreciation of the dollar. So the combination of weak foreign growth and a strong dollar has, both of those things have depressed our export growth and increased imports because imports are cheaper. So that is a drag on the U.S. economy. But again, we have to remember that consumer spending, business investment, residential investment account for 85% of total spending. And domestic spending is on a solid course. It's been growing around 3%. So the combination of solid domestic spending coupled with a drag from abroad that has been operative and will continue to be operative, overall on balance, that's led, and I think it will continue to lead, to growth that is somewhat above trend and on a continuing path of labor market improvement. But of course, it's highly relevant to our decisions, and the strength of the dollar is one factor that means that monetary policy for the U.S. Is more likely to follow a gradual path.
We also have global uncertainty relative to our national security and the world's security, and we seem to be entering a period of time here where violence in one form or another, whether it's domestic, international, whether it's terrorist-oriented or connected to other means, you can lay awake at night thinking of scenarios where coordinated terrorist attacks or just an acceleration of the kind of violence that we're seeing, mass shootings and so forth and so on, could have a negative effect, and I think would have a negative effect on the economy relative to people's fear of spending, going out, enjoying sports, entertainment, other types of entertainment, or going to malls and shopping, et cetera, et cetera. How does that factor into the Fed's thinking regarding its impact on the economy?
So those risks are ones that we watch very carefully, and I would agree with you that it does have the potential to have a significant economic effect. I would not say that I see a significant effect at this point, although certainly in the aftermath of the financial crisis, we've seen rather cautious behavior on the part of households and firms. And while I think there are many different factors that contribute to that cautious behavior, the crisis itself, the slow growth we've seen, many businesses talk about regulatory uncertainty. I would add geopolitical risk as a further factor that is causing that kind of cautiousness.
Thank you. My time has expired, and so I can show a good example to my colleagues in terms of implementing the 5-minute rule. I will call on our ranking member, Congresswoman Maloney.
Thank you so much. Thank you so much, Chair Yellen. In the speech you gave yesterday at the Economic Club of Washington, you said, and I quote, "Many FOMC participants indicated in September that they anticipated, in light of their economic forecast at the time, that it would be appropriate to raise the target range for the federal funds rate by the end of the year," end quote. What are the longer-term trends that would give you the most pause when deciding the timing of liftoff? For example, how will you assess tomorrow's jobs number in the context of its long-term trends?
Well, I think the two things that we focus on most in our evaluation are economic developments that affect the labor market and also those that affect inflation, because our congressional mandate calls for us to achieve maximum employment and price stability. And therefore, in my testimony, I tried to indicate that I do see there are ups and downs. Every series is noisy. We will be looking, of course, carefully at tomorrow's jobs report. What we're looking to see is a continued solid trend of job creation that, while we're close to full employment or maximum employment, at least to my mind, there remains some margins of slack in the labor market. Part-time involuntary employment remains too high. Labor force participation is on a declining trend, but nevertheless, I think it is to some extent depressed by the fact that the job market hasn't been stronger. So we want to see the economy being on a path where we'll continue to erode that labor market slack over time. So we'll be looking very carefully at that. But we can't overweight any particular number. We need to be looking at underlying trends in the data and not overweighting any number. Inflation is also clearly very important. We articulated several years ago that the committee has a 2% inflation objective. Inflation has been running significantly below that for some time. Just as we don't want to see persistent inflation above our objective, we also don't want to see persistent inflation below our 2% objective. So as I discussed, I think much of it is transitory, but we will be looking at data to see if our expectation that it's going to move up over time will be realized, and those are key pieces.
Chair Yellen, 2 weeks ago, the House passed legislation that would interfere with the Fed's operations in numerous ways. You wrote a sharply worded letter to congressional leadership expressing your opposition to the bill, and I request unanimous consent to place that letter in the record.
Without objection, we will do that.
And you said, and I quote, that it would, quote, severely damage the U.S. economy were it to become law, end quote. Could you describe why you believe that this legislation would be so damaging to the independence of the Fed?
Thank you. Just briefly, this legislation would force the Fed to set monetary policy according to a simple rule, something called the Taylor rule or a variant of it, that would tie short-term interest rates to only two economic variables, the current level of inflation and the current level of output. And while such rules are useful as reference points in thinking about monetary policy, to set the federal funds rate in that way without deeper analysis of what's appropriate for the economy would be extremely damaging. At this point, that rule would call for a federal funds rate well over 2%. And while we might be close to the point at which we should be raising it above zero, I think that if we were to follow that rule, it would be damaging. But maybe more important, I want to say that this is an approach to monetary policy that severely threatens the independence of the Federal Reserve in making decisions free of short-term political pressures in the best long-run interests of the economy. It would subject us to regular GAO audits of our monetary policy decision-making in a way that Congress has decided repeatedly and over many years it's wise to insulate the operational decisions of the Federal Reserve from those short-term political pressures. And I believe that almost all countries around the world have independent central banks. They have recognized it leads to stronger economic performance, and I believe this would be a step in interfering with the independence of the Federal Reserve in conducting monetary policy.
Thank you. My time has expired.
Congresswoman Maloney, we thank you. We understand that you have a series of votes in the House. So Senator Klobuchar.
Thank you very much. Thank you for being here, Chair Yellen. I have my first question actually is about income inequality, and we've done studies on this when I was the ranking member of this committee, and I know you've written extensively on trends. What do you see as the impact, and what do you think could be done to reverse the trend?
So I do think there is a very disturbing trend toward rising income inequality in this country. Economists have looked carefully at many different factors that might be responsible for it, and these are factors that are not recent. They have been in operation at least since the early or mid-'80s. Two that stand out are, first, that technological change has been biased in the direction of increasing the demand for skilled labor and diminishing the demand for less skilled labor, and particularly people who engage in rather routine jobs that can be computerized. So technical change and globalization also appears to have played a role in reducing the number of jobs, especially in middle-income jobs, that can be outsourced or automated away. So I think those are key factors. There are others also that people have studied. So let me just make clear that these trends are not ones that the Federal Reserve can address. The best contribution we can make is to try to achieve our goals, and particularly maximum employment, a job market where people who want to work can find jobs using their skills. But there are many things that Congress could consider. Clearly, the return to education, the gap between high and low skilled people is very high, and so policies that enable individuals to get appropriate education and training, I think those are important. There are many things I think that Congress could do that would make a positive,
So you're saying this is on
difference
us.
here.
This is on
It is.
policy.
It is.
Okay.
It is on you.
In terms of trying
we're
to
trying to
change.
do the best
Thank
we
you.
can.
I agree. Shifting here, we have a lot of, you and I have talked about this, a lot of community banks in our states, and we know we're losing a number of them. Consolidation, Dodd-Frank, which I strongly supported, has protected many of our consumers, but we know for some of the smaller banks, it's been hard for them to do all the paperwork with this increasing regulatory complexity. Any ideas on what we should be doing there? Because I'm sure you agree we need to have strong competition in the banking market, and we don't want the smaller players to just be eaten up.
So I think that small community banks really are suffering from regulatory overload, and I think it behooves us to focus carefully on what we can do to try to diminish those burdens. Let me say that we recognize how high the burdens are in community banks, and for our own part, we are heavily focused on trying to tailor our regulations so that it's appropriate, and we're looking carefully for ways that we can make life better for community banks, especially those that are well managed and have adequate capital. Can we have raised the threshold under our small bank holding company policy so that now banks under $1 billion aren't subject, the holding companies aren't subject to our capital requirements. We're trying to do more of our supervisory work off-site and to target our exams toward risk areas. We're engaged with the other agencies in the so-called Agrippa process, in which we're holding hearings and trying to identify things that we can do to reduce regulatory burden. We'll be reporting to Congress, and I'm sure there will be a number of things that come out of that review that will enable us to take steps that will be helpful. But I do recognize there are significant burdens, and I think it behooves us to address them.
Well, thank you. I'm going to put two other questions on the record. One is an issue that's getting a lot of attention, and that's the $50 billion asset threshold, and your views on if that could be modified with the SIFI issue, and maybe someone else will ask it. And then the second issue is just your views on, I'm a strong supporter of the infrastructure bill that we're about to vote on today, but I would imagine you might have concerns on how some of this was paid for. It wasn't actually a Senate side proposal, but that might affect the Federal Reserve. And I wish we had more time. Maybe someone else, one of my colleagues, could ask that question. But I will, in any case, put it on the record. So thank you.
Appreciate that.
Thank you.
I'm going to exercise a little bit of discretion here and allow you to answer that second question, because I know that is on a
That's great, Mr.
number of our
Chairman.
minds
Thank you.
here.
Yeah.
Just for those who
Yeah.
understand the issue here, we are about to pass a highway bill, which is long needed, but part of the pay for is comes from your bank at the Fed. And the word is that there's plenty of profit sloshing around there that eventually is going to come back to the Treasury anyway, so why don't we take some of it now as an early withdrawal? Do you want to respond to that?
Yes, I appreciate the opportunity to do so. So the highway bill, as I understand it, will take a large share of our operating surplus, which is part of the Federal Reserve's capital, to pay for this bill and not allow us to build it up. This concerns me. I think financing federal fiscal spending by tapping the resources of the Federal Reserve sets a bad precedent and impinges on the independence of the central bank. It weakens fiscal discipline. And I would point out that repurposing the Federal Reserve's capital surplus doesn't actually create any new money for the federal government. If you don't mind my quoting what CBO wrote in scoring this bill, they said as follows: "It's important to note that the transfer of surplus funds from the Federal Reserve to the Treasury has no import for the fiscal status of the federal government. Although federal budget accounting does not recognize additions to the Federal Reserve surplus account as revenues, such additions have the same effects as if they had instead been paid to the Treasury and were counted as revenues. A transfer of those funds would have no effect on national savings, economic growth, or income. So in effect, by taking our surplus, our holdings of U.S. Treasury securities declines, and the interest we would earn on those securities would be money that would be transferred every year for many years to come back to the federal coffers. And by taking the surplus now, you're diminishing the stream of revenues into the federal budget over many years. Now, a central bank differs from a commercial bank, and the role of capital is somewhat different. But almost all central banks do hold some capital in operating surplus, and holding such a surplus or capital is something that I believe enhances the credibility and confidence in a central bank. And so on those grounds as well, our policy, we don't have a lot of capital, but we've long had capital in surplus that I think creates confidence in our ability to manage monetary policy.
Well, thank you. I think it was
thank
important
you.
to get an answer to that question. It's so relevant right now.
Thank you. I appreciate that.
And there is the narrative that this is easy money. I think you've given us a pretty good response to that question.
We appreciate it.
Thank you very much.
Senator Cassidy.
Hey, Madam Chair, thank you for being here. I share, segueing off of Senator Klobuchar's concern about income inequality, you have written about the problem of those who are involuntarily working part-time. We've also looked at that, and knowing that you know this, but just for context to the further conversation, Pranay, will you hold up the poster, please? We've noted that this effect is not upon all quintiles, but disproportionately upon the lowest quintile. So if these are the 5 quintiles of workers in terms of income, actually post-recession, most have returned in terms of the average number of hours per week, except the bottom quintile is the one which is still lagging way behind. No dispute there, I'm sure. I think it's your data, so I'm guessing you'll agree with it. And my concern is that the CBO did a study pointing out the marginal tax rate that the Affordable Care Act essentially puts a marginal tax rate upon the employer providing employment. If someone's working full-time, obviously you got to pay more to give them insurance, and that effect is seen most profoundly upon that lowest quintile of workers. Would you agree with all that?
Well, so I think the data that you presented is interesting. I'm not aware we've tried to monitor ourselves, but and others have looked at the impact of the Affordable Care Act. I'm not aware that it has had a very large effect on the phenomenon that we're talking about. It's, of course, worth monitoring going forward. You know, it is important to note that the degree of involuntary part-time employment has declined quite a lot as the economy
But not
has
in that lowest
recovered.
quintile. Is that a fair statement? I mean, that data, which is from the Bureau of Labor Statistics, shows that it persists in that lowest quintile,
It does persist, but it's diminished.
relatively speaking, but still far greater than this point in previous recoveries.
Yes, I think it is disproportionately high.
Now, let me ask, and I'm sorry to interrupt, but he's going to hold me to 5 minutes. I'm looking at something from Valletta and Bengali from 2013 that suggests that rising costs for health benefits may prompt employers to shift towards part-time work to hold labor costs down, perhaps intensified by the ACA's requirement that medium-sized and large employers provide health benefits, et cetera. Now, again, intuitively, if the cost of health benefits is added to the wages paid as total compensation, the marginal effect of increasing the cost for health benefits for the lower quintile is going to be greater than the marginal effect for the upper quintiles. So I'm just curious that as much as you've looked at this, that's not something that you've noted. I'll move on if you just say, well, I haven't, but would appreciate any further thoughts you have regarding that.
I mean, I'm not aware of any estimates of the size of it. Most significant size employers have covered and continue to cover their workers. So, well, there's been a lot of anecdotal discussion of this. I've not seen a study that shows that it's large.
Then let me return to something you said earlier, that you implied that the dollar will weaken over the coming year because you said that both the price of oil you implied would begin to rise.
I'm sorry, I didn't mean to make a forecast about, I don't believe I did. I didn't make a forecast.
So in terms of the
about dollar.
inflationary pressure, you said that you thought that the downward effect upon inflation will be eased because of the kind of return to the norm, both.
If I might, when the dollar appreciates while it's moving up, that tends to push import prices down, which cuts inflation. But if the dollar simply stabilizes at a new higher level, then inflation is no longer held down. So simply stabilizing the value of the dollar, stabilizing at a new higher level,
let me ask, will that also
diminish that effect.
Will that also apply then once it plateaus? It still intuitively seems to me that our manufacturing is going to be negatively impacted.
Yes, that is true. I mean, I think that the strong dollar has been one of the factors along with the cut and drilling activity, yes.
If the EU is planning, the ECB is planning to stimulate, and we are sending signals that we're going to raise interest rates, it seems like we're creating a dynamic where the dollar will continue to strengthen.
Well, the dollar has strengthened quite a lot over the last year and a half.
But do you anticipate that plateauing, or do you anticipate that continuing? Because if it continues, you mentioned how the downward pressure on inflation eases once stabilized. But if they are stimulating and we are raising rates, it suggests that we might continue to rise.
Well, I believe much of that expectation is already built into the market and into exchange rates. So I think that that explains, importantly, why the dollar has risen as much as it has. I wouldn't forecast where the dollar is heading.
Thank you. I yield back.
Just a comment off the side, but related to that, I noticed this morning that the euro actually rose based on the decisions made by the ECB, which surprised me. But perhaps the thinking was that they were taking the right path to get the economy to a better position. And I don't know if you want to just remark on that, but I just thought that was. I fully expected the dollar to strengthen this morning against the euro, and it didn't, based on what the ECB did.
Just watching a little bit of this morning's events, my understanding is that the market expected some actions that were not forthcoming.
That's always been the problem with the market, isn't it? We can never predict what it's going to do. Senator Heinrich.
Thank you, Chairman. And Chair Yellen, welcome again. I want to kind of return to this line of questioning that Senator Klobuchar and Chairman Coates had touched on with infrastructure in particular. And I want to thank you for very diplomatically describing why it's a bad idea to pay for things in this way. I might be less diplomatic in my characterization of those types of pay-fors, but I think it's very important that we, in our efforts to pay for things as important as infrastructure, have honest payments. One of the changes that was made along the way had to do with the exemption of community banks from that sort of structure. And at this point, Fed member banks with assets less than $10 billion will be exempted from the changes in the Fed share dividend rate that were included in the Highway Trust Fund bill. Community banks in New Mexico and across the country depend on the Fed share dividend for its solid return on capital investment. And I've been very vocal about how misguided it is to ask small community institutions to finance our nation's infrastructure. Do you have any thoughts on what the impact could have been, especially given your previous comments today on the regulatory burden on those institutions, had that change not been made to the pay-for?
So, I mean, obviously, there would have been a burden on those institutions. Something that worried me is that it might affect the incentives of many of those institutions to be members of the Federal Reserve, to be members of the Fed system. And I thought that was something that before one makes a change of that significance, it's wise to think through more fully.
Do you think it would have any impact on their ability to, on the decision-making in terms of lending to small businesses that are on the margin of their business plan?
That's difficult for me to say. I mean, clearly there is a tax in that, but I don't know how significant that would be to lending decisions.
So shifting gears a little bit by just going back to interest rates, by potentially raising interest rates, the Fed would endorse the idea that our economy is on a stable path towards full recovery. And I'm interested in how this potential action may signal improving conditions for job creation in states like my own, especially given the fact that New Mexico and a number of other states have not experienced the same economic recovery as the country as a whole has. Do you have thoughts on that?
Well, there certainly are differences across states and localities in terms of how much the recovery is aided in employment in those states. My expectation going forward is that the labor market and the economy will continue, the labor market will continue to improve, And eventually, I think all states will see improvements as that occurs. But of course, the exact industrial structure of a state can matter. But there probably have been improvements, substantial improvements, and I think the labor market will continue to improve over time.
So returning to an issue that a number of my colleagues have raised, just generally, when you're looking at a situation where the FOMC is looking at increasing interest rates, but the actions of other central banks around the world are in a countervailing direction, how do you overall factor in the actions of those other central banks into the broad picture, and how does that impact your decision-making as to whether or not it's the right time to move forward?
So we're trying to assess the overall U.S. economic outlook, and we need to factor in all the different elements that determine that. Our success in selling goods to the rest of the world and the strength of our imports, that's an important determinant of the outlook. And when we have divergent monetary policies globally, it often means that there will be exchange rate movements that accompany that. We have seen that over the last year and a half. And as I've said, the combination of the weak growth abroad plus the movement in the dollar has been a factor that has been depressing net exports, and that's been a subtraction from growth, and I think it will continue to be going forward. So that's a negative, and of course it's something that makes us much more cautious in terms of raising rates. But still, 85% of spending on U.S. goods and services comes from consumers, investment spending, housing, and for very good fundamental reasons, there's greater strength there. So when we put it all together, we're still seeing an overall picture of slightly above trend growth, ongoing improvements in the labor market. Obviously there are risks. There are risks that come from the global environment that we have monitored carefully and recognize. But overall, I would say that the total, while where there's foreign weakness, overall we're on a solid course.
Thank you.
Senator Peters.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for your testimony here today and the wonderful work that you do.
Thank you.
I want to pick up a little bit on some of the comments you made on income inequality, and I realize that the Fed doesn't have the ability to alter that, but certainly you have to respond to that in terms of your policy making and the effectiveness of how your policy may be, given some really, I think, some significant structural changes that are occurring in our economy as a result of the fact that the vast majority of people in this country have not seen increases in wages. Middle class, in fact, has been stagnant. And it seems to be a disconnect from some of the policy, or the theory, I should say, that I remember learning years ago in economics, that normally when you have increases in productivity, that productivity translates into higher wage levels. We have not seen that. In fact, in recent years, we've seen effect from what productivity has gone up significantly more than wage levels. And if you're looking at formulating monetary policy, you're looking at aggregate demand, and how you get that demand is income in the economy and wages. You mentioned that consumers are 80+% of it, so the more money the consumers have, the stronger the economy is. And yet if it is not growing from wages, then it has to grow from them taking on debt. And yet if we look at the fact that wages have been stagnant, and that actually in recent years as well, I believe we're seeing consumers are starting to deleverage, which is a different trend from what we saw before. You don't have those engines of growth, although in your testimony you mentioned there's a 3% increase in consumer spending, but I believe that is down from previous years as well, where we saw 3.5 or more in consumer spending per year, which led to higher GDP growth. We're seeing this long-term, many-year trend of lower wages, deleveraging of debt, and the fact that most of all of the economic gains are only going to the very top of the income ladder, and the folks at the very top don't spend as much consumer-wise as folks in the middle class. There may be more resources available for investment and other types of uses of that cash. But how do you see this long-term trend of income inequality? How is that going to impact the ability for the Fed to be as effective as it may have been in past years using these tools when those things were in balance a lot more than what we're seeing right now?
Well, that's a great question, and you introduced a lot of different elements into it. Clearly, the trends in income and in having our disposable income for households are one of the most important factors determining consumer spending. And the fact that wages have been pretty stagnant for a number of years, I guess compensation's been growing in the 2 or 2.5% range. That is something we've had to take account of in forecasting what the strength of the overall U.S. economy has been, and it's integral to our forecasts. But I guess I would say that job growth has been pretty solid now for a number of years. So disposable income, in spite of the fact that wage growth has remained in that 2.5% range, there's been a lot of job growth that's added to disposable income. So the saving rate moved up after the financial crisis, and it remains in positive territory and has been pretty stable. So the consumer spending we're seeing isn't largely being supported by taking on additional debt. It is being supported by income that households are earning. As the economy progresses, as the labor market strengthens further, I would expect to see some upward pressure on wage growth. Recently, in measures of hourly compensation and average hourly earnings, I think we've seen some welcome hints. It's tentative evidence. We don't know if it will last, but at least recent data does suggest some upward movement in wage increases. But over the last couple of years, the spending we have seen has been supported by income growth. So inequality definitely plays a role here, and of course we need to see sufficient wherewithal for households to spend in a way that generates a forecast of continuing growth.
Great, thank you.
Senator Casey.
Mr. Chairman, thank you. Madam Chair, we're grateful for your testimony today, your presence here, and your public service. I'll have just one question. I'll submit a second for the record because of the limitations on time that we have today and we have in the Senate as well. I wanted to say first that I was heartened by some of the numbers in the I guess the first page of your testimony that we all have heard, I guess, here or there, but we don't emphasize enough. The statement you made that the economy has created about 13 million jobs since the low point for employment in early 2010. That's good news. Good news on the unemployment rate itself, which, as you note, peaked at 10% in October 2009, declined to 5% in October of this year, so literally cut in half. So that's good news, and I think we should emphasize that even as we highlight or itemize some of the challenges with labor force participation rate or folks folks really discouraged from seeking employment. The question I had, though, was more long-term, and it's really just this one question about steps that we should be taking and steps that you might recommend for long-term competitiveness. One of the policy steps that I hope we could take, and we had a step in the right direction on early learning a couple months ago when we voted in connection with an education bill on an amendment that was my amendment, which was the first time in a decade, really, where the Senate was on record voting on a substantial early learning commitment for the country. just to summarize it, if every state signed up, and it would be optional, but if every state participated, we could have provided early learning to 3 million children at 200% of the poverty level and lower. So a substantial and new investment. We didn't win. We didn't prevail on that vote, but it was good to have a clarifying sense of where people stood. But I guess just my basic question is that, what would you hope we would do on taking steps on long-term investments in a more competitive workforce?
So let me say that I think that one of the most disappointing aspects of U.S. economic performance is that the pace of growth and the pace of productivity growth have been very depressed. They've fallen very substantially from what we saw in pre-crisis times. Now, the good side of it is it hasn't taken very much growth to see a substantial improvement in the labor market. The bad way to read that complex of facts, namely not a lot of growth, quite a lot of jobs, is that productivity growth has been very slow. And ultimately, long-term living standards, how well our children will do and whether or not they'll have better lives than we have, really do depend on productivity growth. And in thinking then, I would say that Congress should put considerable attention into thinking about policies that could serve to speed the productivity growth in the economy, and education is one of the things that would head my list. The fact that we have seen such a large gap between the wages of more educated and less educated workers, that is a signal that there's a high return to investment in education and making it more available. I know there are studies many studies with respect to early childhood education that have particularly pointed to the importance of that in creating skills and better performance. But at all levels, education is important. In addition to that, I'd say it's well documented that support for basic research and development is an important foundation for economic growth. And I would say policies to make entrepreneurship easier and to encourage it. All of those are the kinds of things that are important to long-run trends in economic growth.
Thank you very much. Thank you, Mr. Chairman.
I'm told the House of Representatives is may be wrapping up its voting, and members may be coming back. With that, it gives us a little more time here. We know you have a cutoff time, and we'll make sure we hit that. But if you're willing to stay a bit to see if members come back,
yes.
I know Senator Cassidy would like to. Speaking of coming back,
Yes.
Congressman Delaney, thank you. You're up.
Oh, wow. Okay. Good timing indeed. Thank you, Chair Yellen, for the clarity of your testimony, but more importantly, for your incomparable leadership of the Federal Reserve during this obviously particularly important time. I wanted to focus on your view as to the effect higher interest rates, or let's say it differently, the first step towards raising interest rates will have on borrowing. Because the conventional wisdom is always that lower interest rates encourages more borrowing because credit costs are cheaper. But we've had interest rates at such unusually low levels for such a sustained period of time that that's obviously been a bit of an anomaly in terms of historical rate patterns. And I've wondered if that has kind of psychologically changed people's perspective on borrowing, and if a return to a view that things are more normal, which is what I think many people would interpret an increase in rates, would certainly signal that. At the levels we're at now, modest increase in rates will have, largely an inconsequential effect on debt service coverage. And the free option that borrowers have had, many corporate, you talked about how corporate investment is kind of moderate. New home construction is still below standard or below where you'd like it to be. You worry that a lot of those decision makers have viewed the zero interest rates as kind of a free option. Well, I don't have to do anything because they're so low, and they seem to be low for a long period of time. So I guess my question is, as you look at a day when rates do go up, because that day will occur, as we all know, we were very clear about that, exactly when, none of us know yet, of course. But do you think that will encourage more credit formation, more borrowing, which I personally think will be good for the economy, because of some of these, people will start looking at rates differently?
So a few things I'd like to say. When the Fed takes its initial step in raising the target for the federal funds rate, it's important to understand that that doesn't mean that there is some predetermined path back to
We're not going up a
historically
steep roller
normal
coaster.
rates. So
I
the
understand.
notion that it should be
But it's still
something that will be gradual. I mean, in general, higher levels of interest rates, I think, do tend to make borrowing more expensive and discourage it. But it will occur in the context of a stronger economy with higher income, where people are doing better. It's not the only thing that affects investment decisions or borrowing or spending decisions. So I would not expect to see borrowing go down or lending go down when we raise rates modestly.
Do you think it might encourage more borrowing?
Well, one does often hear, especially anecdotal evidence that I hear along the lines that you're suggesting, that there are people who do feel I have a free option, rates will stay low for a long time, and if they see rates going up, there may be people who are on the fence who may decide now's the hour to act. So
that wouldn't
that
surprise you as an outcome from this decision?
It wouldn't surprise me as an outcome, but we would not be, that's a temporary effect.
And you're not making
in a way, borrowing from the future. So I don't want to encourage the idea that I believe that higher rates in and of themselves would permanently tend to boost borrowing and spending.
Right. One other quick question, if I can. Switching gears, Governor Carney gave a speech about 2 months ago where he talked about one of the long-term risks to financial markets being climate change, because it will cause a repricing of carbon-related assets and potentially the reinsurance industry around risk related to weather. Do you share some of those concerns? I know you don't have much time, so just short answer.
So I thought it was an extremely interesting speech. I cannot say that I'm aware of work that we have done looking at that, but I think it's something that is certainly worth considering.
Do you think you'll be doing some work in that area?
I will. It's something we can get back to you on and have a look on.
Thank you, Chair.
Thank you. Senator Cruz.
Thank you, Mr. Chairman. Chair Yellen, welcome. In the summer 2008, responding to rising consumer prices, the Federal Reserve told markets that it was shifting to a tighter monetary policy. This in turn set off a scramble for cash, which caused the dollar to soar, asset prices to collapse, and CPI to fall below zero, which set the stage for the financial crisis. In his recent memoir, former Fed Chairman Ben Bernanke says that the decision not to ease monetary policy at the September 2008 FOMC meeting was, quote, in retrospect, certainly a mistake. Do you agree with Chairman Bernanke that the Fed should have eased in September of 2008 or earlier?
You're talking about 2008 or 2007?
2008.
I mean, I think the Fed responded pretty promptly in easing monetary policy to the pressures that were emerging. And I mean, I don't disagree with his analysis of a particular decision, but I certainly wouldn't say that that decision is what caused the financial crisis. And by December of 2008, the federal funds rate had been lowered to 0.
So when you say you don't disagree, does that mean you agree with Chairman Bernanke that it was a mistake?
So I can't recall the exact passage that you're referring to. So before I say if I would agree, I'd like to have a chance to review exactly what he said.
Well, I would be very interested if you would have the opportunity to review the passage and let the committee know whether you agree with his assessment.
Okay.
I want to shift to a different Fed chairman, which is Paul Volcker, who said in a speech before the Bretton Woods Committee last year, quote, "By now I think we can agree that the absence of an official rules-based, cooperatively managed monetary system has not been a great success. In fact, international financial crises seem at least as frequent and more destructive in impeding economic stability and growth." Chairman Volcker went on to say, "The United States in particular had in the 1970s an unhappy decade of inflation ending in stagflation. The major Latin American debt crisis followed in the 1980s. There was a serious banking crisis late in that decade, followed by a new Mexican crisis, and then the really big and damaging Asian crisis. Less than a decade later, it was capped by the financial crisis of the 2007 through 2009 period and the Great Recession. Not a pretty picture. Now, you have said, quote, "It would be a grave mistake for the Fed to commit to conduct monetary policy according to a mathematical rule." Do you agree with Chairman Volcker's characterization that, quote, "the absence of an official rules-based, cooperatively managed monetary system has not been a great success and not been a pretty picture"?
Well, you've pointed to a large number of very damaging financial crises, and in that sense, I do believe it was very important for us to take steps to have a stronger financial system and one that's less crisis-prone. I don't think that former Chairman Volcker was proposing a rule-based monetary policy in the sense of following a simple mechanical rule. And I guess I would argue that many countries do have, in essence, a rule-based monetary policy in the sense that most countries have inflation-targeting regimes and transparent monetary policies where the central banks are independent and spell out and are accountable to achieve an inflation objective. And the Federal Reserve has very much strengthened its transparency as to what our goals are, what our strategy is for trying to achieve those goals, and provided the public with very detailed forecasts of what policies we think are appropriate to achieve the goals that Congress has assigned to us, including a 2% inflation objective. And over the last 20 years, inflation has been highly stable, around 2%. So in that sense, even though we may not follow the Taylor rule or some simple mathematical formula, I believe we do have a rules-based monetary policy in the United States, or at least a systematic policy in the United States, and many other countries, most other countries do as well.
And one final question. In 2008, the Fed began paying interest on reserves. In the 7 years since then, do you know how much in interest the Fed has paid to banks under that policy?
It's been set at 25 basis points, and I don't have the exact numbers at my fingertips, but I want to say it is a critically important tool of monetary policy. It's a tool that almost most certainly advanced countries' central banks have and rely on as a key tool of monetary policy.
So
And
what
it's
has the
one-
impact been of paying billions of dollars to those banks in the last 7 years?
It's helped us to set interest rates at levels that we thought were appropriate for economic growth and price stability in this country.
Thank you.
Senator Cassidy.
Madam Chair, I get to go again. A lot of turmoil in China. There's an earlier discussion about how obviously foreign markets are part of how we judge our growth. China may be devaluing their currency. It seems like they've weakened their currency. I could go on things you know better than I. What do you see as the stability of the Chinese market, and how does that impact us?
So China has grown obviously very rapidly for a very long period of time, and in recent years has been on a general slowing trend for reasons that are entirely understandable, namely slower labor force growth, a reduction in the pace of investment growth, a desire that they have, which is in their own interest and one that we share, that their economy rebalance from such heavy dependence on trade as a source of growth to domestic consumption. And as they've moved toward the technological frontier, further progress in adopting technological
Can I interrupt for a
changes
second?
tend to slow.
Are they truly attempting to increase domestic consumption? I always had a sense the way that they kind of encourage savings and use those savings to, among other things, prop up their stock market, that their rhetoric says that they are attempting to increase domestic consumption, but their policies do not seem to reflect that rhetoric.
So my impression is that they are trying to rebalance their economy. Consumer spending is a smaller share, a far smaller share of their economy than consumer spending is of ours. And it has been growing rapidly. There are challenges that they've faced in trying to boost it, but I believe that that is a course that they're on that they regard as in their own best interest, and we would agree.
Okay. The changing subjects. By the way, so you feel as well the turmoil we're currently seeing and the threat that they might devalue their currency, just to be specific, you don't feel like that threatens our economy, nor that they are attempting, and let me ask a secondary question, are they attempting to, if you will, game it by increasing their exports by devaluing their currency, et cetera, et cetera?
Well, there was disruption last summer in financial markets when they made a decision to devalue the renminbi by a couple of percent. I think to put that in context, remember that the U.S. dollar has been rising, has been appreciating significantly over the last year and a half, and the Chinese currency has been linked to the U.S. dollar, and so during that period, the Chinese currency had been strengthening rather substantially relative to many of its trade partners. And they made a modest adjustment of their exchange rate, but in a way that was arguably not well communicated and proved disruptive. And then they saw very large capital outflows. I think they recognized that stability of their exchange rate is probably in their best interest, but ultimately would like to move to a more market-based and flexible system of exchange rate determination.
I wish you were their central banker. I'm not sure that, but that said, I hope you're right. Secondly, in January of this year, the economy actually slowed. I think growth actually became negative. At the time, it was attributed to slowdown in the energy market because oil prices had fallen, so energy states, which have produced a lot of jobs, and by the way, jobs for those lower income, less skilled workers that we've spoken much of here today. Now it seems as if that, fell. Oil production rose a little bit for a variety of reasons, and now it appears that oil production is decreasing once more. The rig counts are falling. My state's impacted by this. Any comments upon how this shedding of jobs in the exploration and production component of the energy industry is going to impact our economy?
Well, we have seen a huge decline in oil prices for reasons pertaining to both huge increases in supply and perhaps some slowing in demand. It has had an enormous impact on drilling activity, on jobs in that sector, and that has been one of the things that has been holding back growth.
So even though we've gotten some benefit for consumer spending in terms of employment, now going forward, as those jobs are further shed, what impact do you feel like that has upon our growth? I'm struck that your forecast is that the economy is going to continue to grow at this kind of 2.5% rate. Not the 3.5% we had under Reagan and Clinton, but this kind of 2.5%. But if we're shedding all these jobs in the industry, which provides such a tremendous number of jobs for less skilled workers, it seems as if that endangers even this 2.5% growth we have.
Well, remember that we have been creating roughly 200,000 jobs a month for the entire year.
Now, I was told once that it actually takes about 270,000 jobs a month to both bring back into employment those who are currently unemployed, to take care of those but who would prefer to work, and because our labor participation market is so low, for those newer workers who are entering the market, to employ them, as well as to maintain full employment for those currently. I'm struck that something I read speaks of those 20 to 25-year-old workers being underemployed, higher rate of unemployment among those. So all this to say, 210,000 a month, is that adequate to both increase job participation, but also to account those who are newly entering?
So to simply provide jobs for those who are newly entering the labor force probably requires under 100,000 jobs per month. And there's a downward trend in the labor force due to its aging. If labor force participation is stable, that helps to absorb people who are discouraged and have dropped out, but that still requires quite a bit less than the 200,000 or so jobs a month
But in terms
that we
of
have had.
in terms of increasing back up to full employment, our labor market participation is the lowest it's been since Jimmy Carter. And so whenever the president speaks about how great the unemployment rate is, I always think our labor participation is as low as it's been since Jimmy Carter. So I guess my question is, how do we increase our labor participation as well as take care of those who are entering now? Because we don't seem to be accomplishing that with even a 210,000 per month labor growth.
Well, we are on a path of declining labor force participation due to the aging of the workforce, of the population. So I don't think that we should expect to see labor force participation move up a great deal over time. If it were simply stable over time rather than on that declining trend, I think we would be absorbing people who are perhaps discouraged and in a stronger job market would move back. But 200,000 jobs a month is enough to make progress on those dimensions.
I yield back. Thank you.
Thank you, Senator. We've had the return now of two of our key members of the committee, and so we have a little bit of time. We have a hard 12 stop, so we have time for both of you to ask your questions.
Thank you, Chairman. Thank you, Chair Yellen. Sorry about the vote. So in your comments when I was here earlier, you mentioned moderate growth within the economy. But yet, earlier this week, economists at Citigroup predicted that not only a tightening of the U.S. labor market will force the Fed to increase short-term market or interest rates more rapidly than was anticipated, they said it would result in an inverted yield curve, which typically precedes a recession. And then actually they said, the economists said, that they would assign about a 65% likelihood of a recession in the United States in 2016. Now, 65% seems high to me, but I'm not an economist and I'm not the Fed chair. But zero risk may be too low as well. So what would you assign a risk level of a recession next year?
So I don't have a number for you, but a decision on the part of the FOMC to increase rates would only occur in the context where the committee believed that we were going to enjoy at least somewhat above trend growth so that we would see an improvement in the labor market. And of course, there's always uncertainty that pertains to the economic outlook. There are always shocks that occur. The risks are on both sides. They're to faster growth and also slower growth. I can't put a number on the risk of a recession, but I absolutely wouldn't see it as anything approaching 65%.
Okay. So assuming that you either do something or don't do something with respect to interest rates, I think everybody would probably agree that regardless of what you do, historically speaking, interest rates would still remain at a historically lower level. What tools would you have? What tools would the Fed have if indeed the economists at Citi were right and the U.S. did go into a recession? What would you have to mitigate the effects of such a problem?
So we have all of the tools that we've previously used to try to combat a recession. First of all, if we had raised rates, we would have the possibility of lowering rates. Important to markets in setting or determining longer-term yields is expectations about the future path of policy. For a number of years when after rates had hit zero, we discussed the reasons that we thought it would be appropriate to keep rates at low levels as it turned out 7 years, almost now at zero rates. We discussed why we thought we would be keeping rates at low levels for a long time. And as the market absorbed the notion that they will stay low for a long time, longer-term yields came down. Of course, we had asset purchases. We undertook substantial asset purchases in order to stimulate the economy. I think those purchases were successful as well in conjunction with that forward guidance in bringing down longer-term rates, and those tools are still available.
Last question, and real quick. I met with a group of Ohio bankers yesterday, and in December, they brought up to me the Basel Committee on Banking Supervision is planning to finalize new rules for the amount of capital that banks are required to hold against their trading book assets. We understand the current proposal could have a negative impact on the financial market liquidity and significantly increase borrowing costs for Americans and American businesses. So by some estimates, they told me the regulatory changes proposed by the committee would increase mortgage and auto loans by 1.5% and home loans in America by as much as 6.3%. I'm a former realtor, so that number just kind of popped out to me as a huge, huge problem. So there are real concerns in the lending community in Ohio that the Basel Committee's rules would make borrowing money more expensive and hinder growth in Ohio, as well as across the country. Does the Fed support the Basel Committee finalizing the proposal before these serious concerns are addressed? And will you be conducting your own cost-benefit analysis of what impact the rules would have in our country?
I believe the Fed is taking part in those discussions along with other regulators, but I am not aware that there is any thought. Capital requirements on those positions did go up previously. I'm not aware that there is any thought of changing those requirements in the manner that would have the kind of impact that you're discussing, but we can try to get back to
Great.
you on
Thank you.
this.
Thank you, Chairman. My time has expired.
Congressman Swigert.
Thank you, Chairman Coates. Madam Chair, how are you? First, because I promised my team, we wanted to extend a thank you to your staff and your team for sort of tolerating many of our very technical written questions and some of the responses.
Thank you.
It's appreciated because some of them are lengthy in nature. Can I take us a slightly different direction? And look, I'm blessed to sit on financial services, so we get to cross each other's paths quite often. As Mr. Teaberry a little while ago was discussing some of the indexes and some of the economists who are saying, look, there's storm clouds in the horizon. Our team, we've been collecting information about worldwide debt, and does that cause any fragility to us in North America? And when I'm seeing numbers that in the last 9 years, developing countries, 57 trillion new debt, which is about double their GDP growth. Worldwide debt is 300% of GDP. How do you, from a policy standpoint, as you're looking at an environment of possibly future interest rate adjustments and the effects that will have on U.S. currency, at the same time with, let's face it, a developing country debt, I won't call it crisis, but debt stress on the horizon. A, how does that affect your decision-making? But B, does that provide us any fragility to our economic growth or even potential recession threats?
Well, it's certainly something that we take account of as we try to evaluate the global environment and the likely impact it could have on the United States. And it's something we look at as well as part of our financial monitoring to try to determine whether there are risks that could impact financial stability in the United States.
And now will the Fed engage in certain bilateral agreements or swap agreements with some of the, we'll call them developing countries, federal or reserve banks to actually help wall off a cascade effect? Those of us who remember the tequila crisis and the others, what inoculations, what indemnification does the Fed engage in from a policy set?
The Fed has swap agreements with a very small number of advanced country central banks where we think it's important to make sure that banks doing dollar-based business have access to adequate liquidity. We have no swap arrangements with emerging market countries, and the only reason that we engage in those swap market arrangements is to essentially protect financial stability in the United States. So there is no, I don't know the word, did you use indemnification?
Yeah, I was trying to find a way, inoculation. I guess we could pick up a few of them.
No, I mean, these are risks that we consider in looking at U.S. financial markets. When you talk about debts, I think, what's been discussed over the last year or so is the fact that private companies in many emerging markets have taken on dollar-denominated debt. I think my sense is that the banking systems and the financial sectors of those emerging markets have been much more carefully regulated in recent years and are less vulnerable. They have themselves less dollar-denominated in short-term debts. But the companies, corporations in these countries have taken on a large quantity of debt.
Do you see any cascade risk from developing countries in both sovereign debt loads and private debt loads in those countries that would affect our economy?
It is a risk that we monitor. I would not at this point say that it's a very serious risk to the U.S. financial system.
Okay. And this is not meant to be sort of another one-off question, but we were looking at some data about a month ago, and we'll call it dollar-euro contracts, and the movement away from their being settled in New York. And some of that I did not know was because of a regulatory or cost situation. They were not being settled under our regulatory environment. Does that movement of dollar-denominated contracts being settled overseas have any threat or difficulty to the Federal Reserve's ability to both see data but also influence regulatory and even the movement of those resources?
So I'm not aware that there is such a trend, but I will try to look at that and get back to you.
Okay, that's one of those technical written questions we've submitted. Mr. Chairman, yield back. Thank you.
Thank you. I just want to inform members here, the chair has a need to leave at noon, and we want to honor that. I've just talked to the vice chair, and she agrees, which means maybe what we can do is I want to give everybody a chance to get a question in, but could we limit it to one question and maybe keep it to 2 to 3 minutes so that everybody has an opportunity to do that before we run out of time. Dr. Adams, you're the next on the line here.
Thank you, Mr. Speaker, Mr. Chair, and thank you, Ranking Member Maloney, for hosting the hearing, and Chair Yellen, thank you for being here. Based on the commentary I've heard from some of my colleagues making the media, claiming that the Federal Reserve overreaches in its ability to adjust interest rates, it may not be clear that one of the most important factors impacting how the Federal Reserve will set interest rates is based on what's called the equilibrium real interest rate, which has been consistently low and maybe even below zero. And given that the equilibrium rate is very low, close to zero, what has not been receiving enough attention is how fiscal policy should play an increasing role in stimulating demand and providing an uptick to the economy. Since the Federal Reserve has limited tools on how it can impact economic recovery through monetary policy, including adjusting interest rates and implementing quantitative easing or forward guidance, can you speak to the impact that fiscal policy, particularly sequestration, and the lack of support and certainty for certain tax expenditures, even financial tools, as the Export-Import Bank has had on the rate of recovery for our economy?
Well, let me say generally that there is evidence that the so-called equilibrium rate, this is a real rate of interest or inflation-adjusted rate of interest, fell sharply after the financial crisis and remains quite depressed. And it is a factor that leads us to believe that even when we start raising rates, that those rate increases will be gradual. Now, in general, when this rate comes down, it means that rates are likely to be lower than the historical norm. And to the extent that we are operating in a low, even if positive, interest rate environment, if the economy is hit by negative shocks, well, we do have tools that we can use. Our most sure and certain instrument of policy is the Fed funds rate. So when the average level of the Fed funds rate is low, we have less room to respond to negative shocks. So it would be helpful to be an environment and give us more scope to be stimulating the economy and responding to adverse shocks if the average level of interest rates were somewhat higher. And I don't want to give you advice on fiscal policy. That's up to you, but a more stimulative fiscal policy is something that would, in a sense, enable the Fed, on average, to have somewhat higher level of rates and then to have more scope to respond to negative shocks.
Thank you very much, Mr. Chair. I'm going to yield back.
Congressman Byer.
Thank you, Mr. Chairman. And Madam Chair, thanks so much. The recent FOMC projections have a median longer run unemployment rate of 4.9%, which is very close to what we always taught was maximum unemployment. But the broader labor market that the BLS uses, the U6, counts those who have recently given up looking for work or are employed part-time for economic reasons, and the U6 stood at 9.8% in October, which is still higher than its average 9% during the last economic expansion from 2001 to 2007. So this suggests there may be still considerable slack in the labor market. So how important is the U6 and other labor tools? And basically, given the considerable slack suggested by this 9.8%, is this going to be the right time to raise rates?
Well, so I would agree with you that U6 remains elevated relative to its historic norms. It is higher than I would have expected based on our historical experience, given where the standard or U3 unemployment rate is. And it's one of the things that leads me to believe that even though we're close to that 4.9% median, there does remain a margin of slack in the labor market. An important part of U6 that makes it that high is involuntary part-time employment. And while that's come down substantially, it's hard to tell for sure because there is a trend over time toward more part-time employment in the U.S. economy. But I believe that it remains higher than it ought to be in a so-called full employment economy. In addition, as you noted, there are also discouraged and marginally attached workers, and a fair number of them. Again, that's come down too. So I do see margins of slack, and I think they are reflected in that discrepancy in U6.
Very good. Thank you, Madam Chair.
Congressman Paulson.
Thank you, Mr. Chair, and thank you, Chair Yellen, for being here. I appreciate your patience. I'm going to follow up a little bit on what Vice Chairman Teeberry had mentioned, and it's more along the accumulative impact that I have concerns with from the regulatory perspective, right, that financial institutions or the financial sectors had to deal with. And I'm thinking of the recent adoption of capital surcharges and the total loss-absorbing capacity, this TLAC proposal. Can you just maybe describe a little bit what all of these changes mean on an accumulative basis, either on the industry and on the economy, and in particular, this cost-benefit idea or analysis? Have you done, or has it been talked about or discussed about doing a more comprehensive cost-benefit analysis of what the accumulation of all these regulations have on the industry in particular and on the economy? And I'm just thinking from the perspective of this regulatory rule book has been in a constant state of revision essentially for the last 6 years. And so maybe describe that a little bit, and then I'm going to ask, can you see any benefit of pausing the process just to assess that accumulative impact on regulations and what's having on the economy?
So I do think the regulation is having an important impact on the economy, and my assessment would be the most important impact it's had is to make the banking system and the financial system more broadly far safer and sounder and less crisis-prone than it was prior to the financial crisis. You described two regulations, the so-called TLAC, or long-term debt requirement we proposed recently, and I believe you also mentioned capital surcharges. Now, it's important to understand that those regulations only apply to the 8 largest systemically important banks. In our regulations, we are trying to make sure that community banks that are not systemic, are not responsible for the financial crisis, are not going to be hit with all of those regulations. But I do think it's critically important that the very largest and most systemic organizations need to be safer and sounder. They need to have more capital. They need to have more liquidity. And Congress told us that they need, in the event that they encounter difficulties or insolvency, we need to be able to resolve those institutions. We don't want the taxpayer bailing out those institutions again. And the SIFI surcharges or higher capital standards means that they're much less likely to fail. It gives an advantage to medium and smaller size institutions to the extent it burdens them in competing away their business, and that's safer. And if they did need to be resolved, that loss absorbency that comes from having long-term debt at the holding company is going to be something that is very important, that would enable their resolution either under Title II or under the bankruptcy code. So I do think that, yes, there are some costs associated with these regulations, and it's certainly on parts of it we've done significant cost-benefit analysis, but really there is a huge benefit. And I mean, according to one estimate, the cost to the United States of the financial crisis probably amounted to $16 trillion. I've seen one estimate that puts it at $16 trillion. So having a safer and sounder financial system by having more capital and liquidity and resolvability is really, I think, clearly a net benefit.
Thank you, Mr. Chairman.
Thank you, Congressman Grothman.
Thank you, and I hope this question hasn't been asked before. Your two publicly stated mandates are price stability and full employment. And insofar as when you answer my question on full employment, I want you to remember that we have a lot of safety net programs, and a lot of people feel that we're not going to achieve any better than whatever we're at, 4.9 right now, because the safety nets are so generous. People are either not looking or working part-time because they make so much more on that. But at least right now, price stability and full employment are supposedly where you want them to be. So given that we're in a period of price stability, full employment, and the banking system is recovered, can you explain to all the savers? I mean, I used to represent older people. You know, you'd save money, 100 grand in the bank. You live off the interest rate. Could you explain to our savers and our elderly population why you continue to maintain a zero interest rate, given that it appears we're at full employment, given it appears our banks are stable, and given it appears we have no inflation?
Well, so I would say that inflation is running, I think we're pretty close to maximum employment. Inflation is running below our 2% objective, and we certainly want to see that changed. But the economy is, in the sense that you've described, doing well, and that is the reason that it is a live option for us at our December meeting to discuss, as we indicated, whether or not it's appropriate to raise rates. But we do have to ask the question, what is a so-called neutral rate at which the economy would continue to operate near full employment and approach price stability? And a good deal of research, and I discussed some of this in a speech I gave just yesterday, suggests that the neutral rate of interest is very much lower than it's been historically. In real or inflation-adjusted terms, perhaps close to zero at present. So the level of interest rates that would support a continuation of these desirable trends is probably low. Of course, when we were recovering from the Great Recession with high unemployment, to stimulate all the job creation we had to keep interest rates at very low levels, zero. We are contemplating raising them, but we've said that we expect that process to be gradual, and we want to make sure that having achieved this progress in the labor market, we maintain it and don't put it in danger.
You mean my whole lifetime, when older people put money in the bank and they were getting 3 or 4 or 5%, we didn't know it, but during that whole time we were putting an unnecessary drag on the economy?
We had a different economy then, and many things are different domestically and globally than they were then. The rates of return that savers are able to get depend on the strength of investment demand, the strength of demand for borrowing the funds that savers are trying to provide. And we live in an economy globally as well as domestically where, in some sense, there is a great deal of savings relative to the demand for those funds. And that's a market force that shapes the reality that the Federal Reserve operates in and conditions our ability to set rates that will be consistent with the attainment of Congress's objectives they've asked us to achieve.
Okay, so people are saving more money now, so we can't give them as much interest rates. They're saving more than they used to.
Well, if there were a huge demand for those funds, interest rates would be bid up to the levels that we're more accustomed to having experienced historically. But the demand for those funds is simply not strong enough to generate a level of interest rates that's more historically normal.
Thank you, Congressman. Congressman Hanna has graciously waived his time.
Oh.
But I want to say, Chair, that I think this has been a very instructive and timely hearing, and we deeply appreciate your willingness to be with us. We have a common goal, those of us on both ends of Constitution Avenue, the Congress of the United States, along with the executive branch, but also the Federal Reserve. I think that common goal is to enact and implement sound policies that achieve a dynamic economy that provides meaningful employment, not only for our generation, but meaningful employment for future generations. And the more we can work together and the more we can share how we get to those common goals and pass that on to future generations, that clearly is a goal that has to be pursued with a lot of passion and a lot of intellect, and you provide both, and so we thank you for that. And with that, the hearing is adjourned.